We all know the facts, right? We all know the stats. I looked up some interesting data points before I agreed to do this. We all know that U.S. public listings peaked in around the early 90s, mid 90s, at about 8,000, 9,000 listed companies. We're down to about 4,000. Now that's actually a step up. Last couple of years, actually, we've seen an increase in U.S. public listed companies. But anyone want to gather what percentage of those were SPACs? Who thinks that in the last 5 years, the average percentage of new listings per year in the US were SPACs? 20%. Who thinks it was roughly 20%? Raise your hand, 20. Raise your hand if you think it's over 20. Under 20. More people think under 20. 56% on average. And 3 years ago, it was high of 79% of new listings in the US were SPAC listings. Europe's down to about 9,000 European-wide listed companies, down from 20,000 peak, and we haven't really seen any hot spots. We haven't seen any parts of the world where the public markets have just exploded with terms of number of high-quality companies. So the public listing process is a bit broken. We're going to have Danny talk about why, because he's gone through that arduous process. And then the rest of our panelists all provide different options for maintaining private company status in the face of a deteriorating listings market. So I'm going to start with you, Danny. So walk us through why you chose to go public via SPAC. You're a high-quality company. You had options, right? And what that process has been like over the last 18 months or so.
Yeah, well, quite a journey. We founded CoinShares in 2012, you know, our ethos was let's make it a little easier for people with a normal bank or brokerage account to get access to the crypto markets, and we've issued a lot of securities and a lot of products linked to crypto. Our initial market was private and retail, and it's turned into institutional, and one of the big things that I felt as the founder and chairman and the former CEO was that we needed a legitimacy, and the legitimacy would come through a public market listing. I'd never run a public company before. I'd never managed a public company before, owned one, and the rules and regulations and the framework and the controls and the processes you have to put in place to run a public company are an entirely, you know, elevated level from running a private company. And I think that served us very well. It served us well to help us navigate FTX, Terra Luna, various other, you know, incidents in the crypto market, because we had good governance, we had good accounting, and it helped us credibility-wise with institutional investors. So that was all good. We started off like a lot of public companies do in a minor market. We listed on NASDAQ First North Growth Market in Sweden. It's a real backwater. It's like the AIM market in London. And, you know, I want to call that a dry run. We then uplisted. We thought that would be a little checkbox here and there to graduate to the main market in NASDAQ Europe. That was a much bigger lift than any of us anticipated. It was a bigger lift than the initial IPO. And then having reached the main market, we sort of thought, oh great, we've arrived. And what we found is that valuations are low in Europe, and that and liquidity is low in our stock as well. So we embarked upon various things to improve our fate: investor relations, public relations, more analyst coverage, paying a dividend, and none of this really ignited our stock. And so, you know, it came to pass that we look at the United States market, we looked at NASDAQ in America. We'll be public in NASDAQ America by January. We've agreed a SPAC deal. It's all public information with a SPAC called Vine Hill. It is a really big lift. It's a really expensive lift, but the benefits we get are absolutely enormous. You know, we've created a lot of shareholder value over time, but we haven't transmitted that to shareholders because our share price has been too low. Our multiple on our earnings has been too low. We earn about 100 million a year net, give or take, and our multiple on the European market was languishing at around 2 points. As we go to America, it'll get to 22 points. So we'll pick up $2 billion in enterprise value by listing in America. The question you had is like, why a SPAC? Well, your choices are you do your own listing, you do a direct listing, you do a merger, you do an RTO, and by process of elimination, and made more complicated by the fact that we were already public in a different jurisdiction, a SPAC was our fastest route to market. It is an expensive exercise. By the time we're done with bankers' fees, legal fees, audit fees, and a relatively minimal amount of dilution, because we struck a very good deal with the SPAC sponsors, it's going to cost our company $50 million.
In fairness, you were able to get a low dilution SPAC event for two reasons. One is you timed it right. SPACs are weak, right? Let's face it. Right? There's a lot of desperate SPACs right now that will give up or promote, and you're a high quality company. So you're a good target for
Correct.
a SPAC. But most people don't have that experience, particularly if they take it public via SPAC during an upcycle. They're giving away a ton of promote, right?
Well, that's correct. And people can get up to 20% promote taken out of their deal. We got down to sort of mid-single digits. And the reason is that, the SPAC sponsors have got a stock that's actually quite undervalued. And they're going to keep their SPAC-sponsored shares, and they're going to make money out of that.
Right.
I think of the 70-some SPACs that went in the 12-month period before us, only 2 of them had an EBITDA of more than $50 million. And I think out of the 70-some, only 65 weren't profitable at all. So in terms of trying to raise capital, which we're not really trying to do, then the expense is very high. As a high-quality company, it's actually quite low, and it's much quicker than going.
Yeah, and you get to file an S4, so you get to use forward-looking statements, right? There's lots of advantages. It's a great structure, and for a high-quality company, it can work out. Christiaan, so you are active in the secondaries market.
Yes.
Right. So I want to ask you 2 questions about the secondaries market. Number one, just describe kind of where we are now in the secondaries market. But I've always wondered, I've now, I'm not a young guy, I don't consider myself an old guy, but I have heard pitches over the last 10 years, no less than 30 pitches to institutionalize and reform the secondaries market, whether it was tokenization. The technology is almost irrelevant. Why hasn't the secondaries market, it's very liquid, it's highly brokered. How come it hasn't become more liquid and systematized? Why does it continue to be highly brokered, in your opinion?
What's the second question?
I'll ask it later. So let's start with that. Well, first of all, the state of the secondaries market in your opinion.
So the state of the secondaries market, I mean, and here when we talk about secondary private equity market, we're thinking from an investor's perspective, so mostly LP-led secondaries, so people having private equity positions in funds and saying, there's a market, can I sell for that? And that's a market that over the last 25 years has really institutionalized. And a little bit to your question, why is it not more liquid today? People have tried. There's been platforms since 20 years that have tried to do that. They all happen to end up being like glorified brokers for stakes rather than a platform where you have a liquid market. And the main reason in my mind for that is basically there's a need for information that you don't have if it's very liquid, and there's a need to know who is going to be your investor in your fund. And as long as these two are not solved, you cannot have a real liquidity market. So that's why it's not more liquid than that today.
So the GPs want to control who their LPs are.
Absolutely.
And they don't want, okay. I buy that. I think some GPs are desperate enough to give up some of that control, but I think that's, in general, that's fair. They want to know. I think for them, we'll get to Isabelle in a second on the pre-IPO secondaries. I think for corporate entities, the reason that secondary trading, pre-IPO secondary trading hasn't become really popular is the companies themselves hate it. We talked about this before, right? If I'm a tech company, I want my 25-year-old engineer staying poor. I don't want that engineer able to go out and get their mark-to-market millions pre-IPO because I want them working in a one-bedroom apartment with 5 people coding all night. What do you think about that?
That's probably not going to prevent it from being more liquid. I think it's the
if there's a liquid pre-IPO market, that engineer can become rich, cash rich. I don't want that. No?
Yeah, we had a discussion about that with some friends at dinner yesterday that buy secondary stakes in companies.
Right.
And the big problem is access to information. A lot of people want to do that, and there's a lot of SPV being sold. As long as you don't have access to the information, it's going to be, I know the company, it's a name that everybody knows, I'm going to buy into it. I have no idea why and how and what's really happening, and that's another big...
And you also mentioned the valuation methodologies might be very different for different participants, right? How wide is that spread? When you're bidding on an LP tranche, is your competitor absolutely off on market?
So I've been like during the bubble years of the internet and telecom, so we're talking 26, 25 years ago, the spread was insane. I mean, it was a factor of 10 sometimes. In the buyout space today, it's much smaller, 10, 20%, because it's more about what EBITDA multiple do you use and what EBITDA basis do you use, so much smaller.
Is that because people were using different information sources, different valuation methodologies? What was causing that spread?
At the time, it was really, I remember we had this fund we were invested in, and it's a company that were selling shoes. Like they had 7 shops in London selling shoes. Everybody knows what they do, right? They were valuing at 7 times EBITDA. And we're an investor in this fund, and like late 99, we received the next quarter report, and the valuation of that company had grown 10 times in 1 quarter. So we said, what has changed? And at that time, it was great. What has changed is they came up with a business plan to sell online.
Oh.
That's all. That's it.
Okay.
So now the valuation basis went from EBITDA to multiple of revenues, and they decided to apply that.
They didn't add blockchain to their name? That would have been my call. Okay. And when you're buying these secondary tranches, are you thinking what is the probability of a liquidity event in the next 3, 5, 7 years, or is that not factored?
No, that's core to the secondaries market. It's supposed to be faster liquidity, and I think if you buy into relatively mature buyout funds, it's the case. I think you gave some statistics on the holding period for more venture and tech assets. It's much longer. It's harder to know, and people stay without exit for much longer, private or the same way. But yes, it's a fundamental part of the secondaries market is trying to assess that liquidity. Yeah.
So where we stand today versus 5 years ago, is the secondaries market stronger, healthier, better pricing, more liquidity, or are we about the same?
Well, over 5 years, actually, I mean, you mentioned 5 years, which is a really interesting time frame, and 5 years ago was the beginning of this GP-led market. So the continuation vehicles, which is another great way to exit an asset. And I think people haven't maybe yet fully grasped the extent of this market, because I think the projection for this year is 1 out of 4 or 5 exits in buyout is going to be a continuation vehicle. And that's basically a private equity firm saying, well, historically you could IPO it, you could sell it to a strategic, you could do a secondary buyout, or hopefully not, the company would go bust. All recognized exit ways. And today, or some years ago, someone said, well, I could also sell it to myself, and that's going to be an exit. And that today is nearly a quarter of the exit market in buyouts.
A quarter?
Nearly.
Wow.
20% they expect this year.
So Isabelle, you invest in pre-IPO growth firms, not just tech, but growth companies, correct? So that's another market that I've seen attempts over the last decade, and we have now Forge and some others that have become slightly more popular. But there's second market back in the day, Barry Silbert before he founded DCG. Is that market trending towards listing and liquidity type status, or is it still highly brokered? Where do you see that going?
Yes, well, we invest in both exits. So companies are going to go public through an IPO, companies are going to go public or that are going to exit through an M&A transaction. They'll be bought by a private equity fund or a strategic acquirer within a year or two, so a very short time frame to exit. So we really sit at that intersection of private, exiting private, going public for the most part. We invest primarily in the US, but we invest in companies that also go public in their local market. And we also had SPACs. So I had 3 SPACs, took companies public, the last one still closing.
Okay, so how can you be sure a company is going to, how are you confident a company is going to go public in a year to 18 months? They're already starting, they must be in the process when you invest.
So ideally the company would have either, they would have spoken with the bank and they would have guidance on the valuation, or maybe they've received an offer from a private equity fund, or maybe they have received an offer from a strategic acquirer. So what we seek to have is visibility on the exit valuation to make sure that we get a discount when we invest. So we provide capital beyond the last round of financing and before the company goes public, so that can be bridging the company to the exit in a special kind of situation. It is minority equity, but a lot of companies that we invest in tech, we only invest in tech, need that extra capital to make it to the exit. So they're profitable, for the most part profitable. So that's in response to the demand in the public equity markets now, especially in the US, it's tech but profitable. And many tech companies are profitable, not quite to the point where they can spend 10 million on an IPO, it can be expensive to go public, or maybe they want to complete an acquisition before they go public to demonstrate to the market how they can grow inorganically. And with that in mind, we seek to accompany the companies that we invest in through that transition.
That's interesting. So I think, I can't speak for the audience, but I normally associate pre-IPO liquidity with senior executives wanting to hedge their exposure in advancement of a listing. So you're not providing senior executive liquidity or individual investor liquidity. You're providing growth capital for that 18 months.
We invest primary capital, although occasionally we'll see a mix of, or an opportunity to invest in both a mix of primary and secondary, which can actually be interesting because sometimes companies, just before they go public, they seek to consolidate their cap table that can be pretty fragmented with early investors. Okay. Sometimes they're still maybe a year or two away from an exit, but some employees that might have left. have equity, and they know that maybe it's not going to be 18 months, maybe it's going to be 2-3 years, and they want liquidity now. So actually, a mix of primary and secondary can be interesting because it can bring the valuation down.
So you're working closely with the company. This is a
We
cooperative.
work very closely with the company. We seek
Okay.
to have that primary relationship with the company where we either we take a board seat or again, many of us have done it. So our company, Athena Capital, is supported by a council of 30 executives who have been Fortune 500 board members, founders, CEOs, and they, in addition to sourcing investments, work very closely with founders on accompanying them through the exit to make sure that they get the right coverage in terms of equity research when they go public, to make sure that they get the right structure of capital, the best cost of capital, and that they think about all of the elements that make for a successfully traded stock.
That seems to me like a more sustainable model, because I was familiar with some of the pre-IPO firms that were adversarial to the issuer, where like the company just didn't like what they were doing, because as I mentioned, they were making these engineers rich and they were losing their motivation. So that what you're describing seems like a much more long-term. I never understood a market that could survive when the issuer hated the trading activity. So that makes much more sense to me.
Yeah, we position ourselves as a friendly investor in the founders or the managers sphere.
Got it. Okay. I'm gonna go to Nader because I want to stay on equity for a second, and we'll end with credit. Okay. So Nader, so your approach this a bit differently. You're from a government-backed fund, sovereign-backed fund. So your timeline is infinite to some degree. I know you need to produce returns, of course, but there's no clock ticking from the moment you invest, right? So you invest in a fund-to-funds venture basis. That's right?
Correct,
Okay.
correct. And if I take a step back and talk about our vehicle in a little bit more detail, we're backed by the government over here and we're strategic investors. So there's a non-zero component of what does this mean for the ecosystem here, but more importantly, I do have to show those returns to the investors and all of that, because it has to be a sustainable vehicle. We are an evergreen vehicle in nature. That means we do have the patience to work alongside, being primarily a fund-to-fund vehicle, alongside the GPs that we're backing in order to unlock a value for them, whether it's policy opportunities, whether it's regulatory blocks that we're looking to unlock, whether it's looking at enterprise and getting them more involved in the spaces that they're investing in, to unlock opportunities with them as a node to represent the many as the one that interacts with these organizations, whether it's the policymaker, whether it's the regulator, whether it's these large corporates and multinationals. Rather than dealing with the many, we come as that valuable source both upwards but also downwards to disseminate opportunities down in problem statements, where then the capital can flow and plug in holes that then will serve a big market need. So yeah, to your point, there is that strategic lens on what we're looking at.
I would imagine that, though, being patient capital alongside impatient capital can get tricky every now and then. And we're going to talk to Sharaf in a second about the financing opportunities available of taking out impatient capital. Like, how do you feel if you're an LP alongside another large LP that's dying for an exit? Does that ever get tricky? Do you worry about them getting taken out with different types of financing vehicles and you being left behind, or are you comfortable with your decision no matter what?
Actually, that's a very good question. It's one of the things that we're scratching our heads around is secondary liquidity for other LPs is one of the things that has been coming out quite a bit in the market over here. It's a little bit of an immature sort of space right now where the question is starting to come up. But the biggest part of the journey here is it's a partnership, right? And they love the fact that we're there and we have a stake in the health of the whole ecosystem. We're there where we're not pushing for IRRs, we're there pushing for a multiples return, which is an incentive aligned with them. They're looking for those winners. They want to hold on to those winners as much as possible, and getting pressure from the LP group of liquidate now, I'm looking for DPI, it isn't coming from us. And ideally, we're looking at ways to put...
DPI?
So distribution from the investors.
Right,
themselves.
okay.
So we're not pushing for early distribution.
Mm-hmm.
We're trying to look for growing the ecosystem and its health, right? So how do we prolong the winners to get to stay private longer, to accumulate more value before they go public, finding partners with the people that are sitting alongside me on the panel as well, to see how we can prolong that opportunity, that winner. At the end of the day, there's a power law within every GP's portfolio. You want them to have the supporters from within their LP group that will be there all the way and connecting them to follow-on capital when it comes to ownership, for example, and dilution, looking at credit opportunities that prolong sort of the liquidity runways of their underlying assets in order to find that sweet spot and the exit opportunity. And we're seeing a lot of health in the marketplace over here in terms of options for liquidity. Sovereigns playing as consolidators, strategic corporates coming in, the region's first management buyout that took place last year. So we're seeing a lot of innovation in terms of how are we seeing control being kept with, in some cases, the management. So they're curating the right exit in some cases. And in some cases, we're looking at where we're supporting the GPs and curating the right exit opportunities for them as the investors.
Do you ever double down and take out an impatient LP yourself?
So that's something we're scratching our heads around, but it's not something we've yet put to a product.
That must take a lot of confidence. Like if a Christiaan calls you and says, hey, I got a secondary sale for another LP in your fund at a 30% discount, in one sense, yay, this idiot's selling cheap. In another sense, uh-oh, like maybe I've mismarked it. Like that's got to be, Christiaan, you ever had that conversation? Not with him specifically, but have you ever had that conversation with an LP?
Absolutely. I think it goes back to the valuation, and you just don't know what it means.
Hey, Mike, you got to speak in the mic, I think. Yeah.
Sorry. No. We've had a lot of discussions around why and what something is worth and everything, and it's an endless discussion. I mean, at the end, it's a negotiation. You have buyer, seller.
Okay. Well, it's a great segue. So if you can't decide on the equity valuation, maybe you turn to debt, right? Like you see how nice that segue was. So, Sharaf, you have an interesting product to use credit to get people out of these positions. You talk through what you do?
Sure. So we manage a credit fund. I've been working in credit and private equity in the region since 2008. So we're sitting here talking about liquidity and liquidity events and how to exit. I mean, regionally, you can see private equity really hasn't succeeded in the region, right? I mean, ultimately, there aren't a lot of monster PE shops running around doing acquisitions. And why is that? A lot of it is due to the exit. There just haven't been the exits required. And you'll see that private credit has really grown tremendously in the region. Why? Because it's a self-liquidating instrument, ultimately. In terms of taking people out on the credit side, I've done it personally. So we're looking at a company. There are 3 shareholders. One of them wants to retire and has become a slacker, frankly. And the 2 other guys want to take him out. The companies here are unlevered in the region. So, a lot of the big companies in the US and Western Europe are levered 4, 5, 6, 7 times on EBITDA. So there's no way to kind of do a dividend recap on these types of companies. Whereas here in the region, I think there's going to be opportunities for credit funds to come in and say, okay, this company's levered 2 times, if at all, especially on the tech side where I'm focused. And one of the VCs wants to exit. And so we can lever up this company if they have some cash flows, and the shareholders can buy out the exiting shareholder. There's a very good example of this that happened about a year and a half ago. A US private credit shop came in, Frisco Partners, I believe, and took out one of the big VCs, gave them a good exit, frankly made their fund, and took them out of Property Finder, which is a very large company here in the region. So there are examples here where credit has performed this exit role. It could also help clean up the cap table, as you mentioned earlier. So we've seen opportunities where shareholders will come and say, look, we want capital to come in and help grow the business, but at the same time, we want to take out some of our early angel and seed investors and give them a nice exit. Maybe not the current valuation we believe we're at, but something that will give them a 3x or 4x. And so we have a mix of primary and secondary from a debt perspective. So these are some of the things we've seen. But back to liquidity in the region, it is hard to achieve. It is hard to achieve. And I've done the private equity and I've done the credit. And frankly, the credit is where things have succeeded because the graduation rates, never mind in the West where it's a little bit better, but here graduation rates from seed to A to B to C are very few and far between. And so everyone sees the winners and sees the IPOs, but there's a lot of companies stuck at Series A and Series B, and they're good companies, they have good valuation, but there's just nobody there in the growth equity spot to take them out. And if they're there just aren't enough of them. And especially when people are investing a lot of VC money expecting a 4x, somebody's got to take them out, and it's not always going to be from equity.
Okay. So I was told no Q&A, so let's do a rapid fire final round of questioning. And just bear with me, I'm making these up as we go along. Danny, are we, in our lifetime, we're both about the same age, 30, right? You and I are both 27, 30. Will we ever see 8, 9, 10,000 US listed companies ever again?
Look, I'm not sure. What I do know is this: the US capital markets, you know, when you really get into the weeds, it's the big league, and it's not just the big league because it's one step up, it's 10 steps up. And I think that in as much as we discussed, you know, NYSE making a bit of a play to get more companies listed, they just do need to make it cheaper, and they do need to make it a bit easier, I think, for that to happen. There's no question.
I need a yes or no. I need a yes or no. Come on.
Yes.
Okay.
Yeah.
All right. Isabelle, in our lifetime, will we see, so NASDAQ has an attempt, NASDAQ Private Markets. That was, by the way, NASDAQ bought Barry Silbert's company, Second Market, and that became what is now NASDAQ Private Markets. Will we see a truly liquid private market, like NASDAQ, like it's okay, but it's not great. Will we see a truly liquid, call it a listing board, if you want to call it, private market
No,
business?
that's the point of the public equity markets. And to answer the other question, I do think we'll see those companies come back. There's been a significant decline, I think well over 50% of publicly traded companies in the US in the last 10 years, so
Okay.
20 years. And there's significant demand for investments, especially in tech. So actually right now, a good chunk of the S&P 500 is tech companies.
Okay.
And there's a very significant demand for investments in tech growth, profitable, but tech growth. And that supply continues to be risky in the private market.
Okay.
And the only way to get that exposure is in the public equity markets.
Okay. Christiaan, thank you. Christiaan, Bill Ackman famously said a couple of months ago that he thinks private company valuations, including secondaries, are complete nonsense. They're all 90% overvalued. Now, he was kind of making a point, an extreme point. 30 seconds. Do you agree with him or not?
No. I think there's buyouts, there's venture, there's growth, and you can't look at it all in one bucket. Buyout has kind of cash flows and clear mechanism of valuation. So 90% in that sector is just not going to happen. I mean, if you get it wrong, it's a 20% difference, not 90.
Okay. Thank you.
Venture, I can't comment. I don't know.
Okay. Nader, will we see, this may be unfair because you're a fund to funds, but I'm going to say it anyway, but you're an expert in the region. It's always amazed me, I've been coming here for 25 years, and given the intelligence, the education, the drive, the free markets, it amazes me there aren't more local unicorns. Will we see 20 unicorns coming out of this region in the next 5 years?
We're almost there already, and so I don't see that as a far-fetched thought, but one of the things I do want to throw out there is we don't see exits as milestones in our ecosystem's maturity curve. When we're looking at capital, governance, and trust, it compounds locally, and exits stop becoming that extraordinary feature. They become inevitable. And what we're seeing a lot more of right now, it's becoming an inevitable part of the entire ecosystem with people like the panel here participating in it. I'm
stealing 30 seconds. Sharaf, ending with you. This is not a part of the world that loves leverage. Just right, you don't think of it. I don't think of it that way. Do you see 5, 10 years from now? Do you see leverage levels here on average coming within 50% of what you would see in the West?
Yes, I do. I mean, the credit world has grown so much since I got here in 2008. I mean, now it's, you know, everybody wants to be here. The big guys want to be here. I think leverage levels they're under-levered. People are conservative, and that makes a lot of sense. But I do think on average, there'll be more opportunity for cheaper capital, which is good for the region, and used for all kinds of purposes. So I do think leverage levels will creep up. Whether they get to 50% of Western markets, to be determined, but I think leverage levels will creep up and leverage will be in more nooks and crannies within the capital ecosystem.
Excellent. Everyone, thank our guests. Wonderful.